This 5-mark question on capital and revenue expenditure has featured in AS level business exams many times, and it's one of the easiest places to pick up full marks if you know the structure. Today, I'm breaking down exactly how to answer it. Let's get started. Explain the importance to a business of distinguishing between revenue expenditure and capital expenditure. This question is for 5 marks. To start off this question, we need to define what capital expenditure is. The purchase of non-current assets that are expected to last for more than 1 year, such as buildings and machinery. Capital expenditure will be recorded in the balance sheet, or also known as the statement of financial position. Let's have a look at a basic balance sheet. So here where my purple arrow is, this is where my fixed assets or my non-current assets will be featuring, such as vehicles, machinery, buildings, equipment. Capital expenditure will also affect the value of the business. The formula for owner's equity is assets minus liabilities. Let's have a look at the balance sheet again. At the bottom, you will see your owner's equity, and how I got to the owner's equity of 50,000 is I took my assets minus my liabilities to get my value. Capital expenditure is affecting my fixed assets, and it will then affect the value of the business. So the more fixed assets I have, the more it will positively contribute towards owner's equity. The depreciation on fixed assets is recorded in the income statement or the profit and loss account. Depreciation can lower the profit for the year and therefore the taxable amount. A basic income statement. So my fixed assets or my non-current assets will have a depreciation, a wear and tear attached to them. And this depreciation will feature in the income statement as part of my overheads or my other expenses. It will reduce the taxable profit of the business. Now for the next part of the answer, I need to define what revenue expenditure is. That is spending on all costs and assets other than non-current assets, which includes wages, salaries, and inventory of materials. Now, an easy way to distinguish between capital and revenue expenditure is your capital expenditure is the spending on all fixed assets, and revenue expenditure is basically the spending on everything else. Now, my revenue expenditure is recorded in the income statement, or also known as the profit or loss account. In my basic income statement, where this purple arrow is, this is my overheads or my other expenses in the business, such as wages, salaries, electricity, and telephone, as well as purchases of materials that forms part of the calculation of cost of sales. I'm not delving into how we calculate cost of sales today. Now, revenue expenditure affects the profit of the business. This profit is recorded in the balance sheet and affects the owner's equity value. Now, this profit that we calculated by using our income statement is then transferred to my balance sheet. So here where this purple arrow is, as part of owner's equity, I will have profit. Revenue expenditure can affect the operating profit margin or the profitability of the business. Here is a formula for operating profit margin. It's operating income, or EBIT, which is earnings before interest and taxes, divided by net sales, or my revenue, times 100. So the higher the operating profit margin, the better the business is performing in terms of profitability. If you watch shows like Shark Tank or Dragon's Den, those sharks or those dragons are very much interested in your operating profit margin, because if you have a higher operating profit margin, a higher percentage, it normally is a good sign. Now, just to quickly touch on my earnings before interest and taxes, if you have a look, my operating profit is over here. For example, the 640 in terms of this example. Now, from that, I can still go and deduct my interest, or also known as my financing cost for my business, and then I will get my profit before tax. Obviously, the taxman takes their little bit of your business as well, and then you will be left with the profit for the year, and that profit is then taken to my balance sheet and will affect the value of owner's equity. If you are interested in these PowerPoint presentations, I will leave a link in the description to my community. You can download it from there if you join the community. YouTube believes you'd like this other video, so be sure to check it out as well. See you in the next one. Bye bye.